The other day I heard this. Somebody said there's no way someone can have 15 different whole life insurance policies on themselves. Why would somebody do that? That's bonkers. In a roundabout way, that's what the conversation was. And I said to him, well, 15 years ago, I would have agreed with you. But now I'm that guy. I have 15 policies. You heard that right. I literally have 15 policies. They're right here. But the reason I have so many is not the reason you would think it is. You see, whole life insurance is life insurance, okay? It's life insurance for your whole life, and it's typically used to protect your family for when you die, when you go on to greener pastures. The death benefit in the policies, okay, is based on something called your human life value. And this calculation is done so when you go on to greener pastures, your life continues, at least the life you set continues, and the paychecks continue for your family. Wild stuff to really think about, and it's slightly morbid, but it is one of the things you have to consider. So why would I, and why would so many of the wealthiest families in the world have more than one policy? Well, it's simple. It's because we're not just using the policies for a death benefit. We're using them to become our own private banking system. And each policy is treated as its own banking branch, our own private banking branch. And the individual uses these policies to grow their wealth and solve different problems. So the roadmap, okay, and that's what I want to do. I want to kind of pull back the curtain a little bit on why somebody like myself would have this many policies. And a lot of it comes down to the IRS rules. And the IRS rules called the MEC 7 pay, it limits how much money you can put into a policy, or it ties it, I should say, more to the death benefit. So let me dive in and kind of unpack that a little bit for you. The mechanics of how a whole life policy works, okay? A regular whole life is very different than the specially designed and engineered policies that we're doing here, the ones that I have, the ones I'm gonna talk about. But I am gonna actually show you how two of my policies are traditional, regular whole life insurance policies. When you look at these policies, okay, when I started them in the beginning, it was for the death benefit. I was trying to protect my family, and therefore, I bought these policies based on two different factors, as many people would. Number one, I bought it because I wanted a specific death benefit. I'll use one of my old policies. This one was started in 2014. I bought a $200,000 death benefit. This is how you'd buy term insurance, how you'd buy most life insurance. $200,000 death benefit was what I was looking for. The premium for that was $570.21 per month. Now, this was a custom whole life, okay, that you only had to pay for 12 years. But here's the thing, $570.21. That's what I was putting into it, which is great if you're just trying to buy life insurance. But when I started using this policy and all my other policies, all of these policies for my own private banking system, you're gonna realize very quickly that one, like this one I'm talking about, is not enough because your capacity increases. In other words, as your income goes up, as your net worth goes up, and all of you will have the same thing happen, your income will go up over time, you wanna save more money. And if you had your own private banking system, that would be where your money starts. Instead of keeping it in a traditional bank, once you understand how whole life works and how these specially designed whole life policies works, you would definitely want your money in the whole life. So I'm not gonna get into that in today's video, but I do wanna kind of preface that once you know, you know. The growth of the policies is really the reason. So I'm just gonna kind of give you some specifics here and we'll show these a little bit closer, but these are just insurance policies that I started, okay? I'm gonna show you a couple of these statements. Now, I can't give you all this because it's got my policy numbers, but this is that same policy that was started in 2014, premiums $570.21. Now, I gotta hit on Dave Ramsey. Dave Ramsey says that when you die, the insurance company keeps your cash value. Okay, so you're only gonna get the base face amount. Let me just unpack that. Here is a policy statement, and this is from 2021 to 2022, okay, right here, 2021 to 2022. My base death benefit was $200,000. And I know Dave says that that's all your family's gonna get. So then Dave, please explain to me why my total death benefit here on December 1st, 2022 is $224,174. I'm just making a point that the death benefit goes up, and it goes up because your cash value grows. And as your cash value grows, you start making a better return on your money. And I'll just read this one from 2021 to 2022. During the past year, your base plan guaranteed cash value increased increased $6,184 from $34,416, that's the cash value, to $40,600. In addition to this increase, your annual dividend was $1,537.10. So that would mean if you took the premium I paid in minus the growth on the policy, both the dividend and the cash value, I would have netted roughly about $1,255, give or take a penny or two. That's a 19% return on my money. If you took $1,255, divided it into what I put in that year, it's a 19% cash on cash return, which that's just that year. I'm gonna go 1 year further, and I just wanna show this. So right up here, you can see December 2nd, 2022 to December 1st, 2023. And we're gonna do this on a couple, because I'm trying to tell you how I ended up with more than one policy. But we're only gonna start with this one policy, which is not my oldest, but it's one of the older ones. Here we go. The same base plan death benefit is $200,000, but now my death benefit is $229,533. Remember the one we just did a second ago? The death benefit was only $224,174, so the death benefit's going up. But let me read you the important part, okay? This is where you start thinking, wow, maybe I should put more of my savings, more of my income into these policies, because this is pretty impressive. Remember, this is just 1 year that has gone by from the one we just talked about, same policy. During the past year, your base plan guaranteed cash value increased $6,406. Remember before, it was $6,184, from $40,600 to $47,006. In addition to this increase, your annual dividend was $1,644.69. The year before it was $1,537.10. Okay, so the total growth on that policy this year, total year-over-year growth, was $8,050.69. Net out the premium I paid in that year, I made $1,584.69. Remember, the year before it was only $1,255, which means I went from a 19% cash on cash return to a 24.5% cash on cash. Now, I'm not gonna bore you with all the statements as we go, but let me just go to this one, because we're gonna wrap with this. This one is December 3rd, 2024 to December 1st, 2025. Same policy, all the things. My death benefit is now $242,672, but let me read you that one that really matters, right? During the past year, your base plan guaranteed cash value increased $6,888, from $53,648 to $60,536. In addition to this increase, your annual dividend was $2,300.23. Doing all the math. Take the premium I paid in minus my total growth of this policy, which was $9,188.23. That would mean that my net gain, net of commissions, net of cost of insurance, net of policy service fee, is $2,345.71. That is a 34.2% cash on cash return. So when you really start thinking about that, we just talked about one of my 15 policies here. But when you think about that, you're like, wow, I think I want to put more money into this. But that thought isn't going to come into your mind until you start using the money. Because listen, you'll never get wealthy. I just want to preface this. You'll never get wealthy just putting money into a whole life insurance policy, not even a specially designed whole life policy. It's just better than the alternatives, like a bank account, a high yield savings, a money market. It's just better because you're getting guaranteed interest, which is typically higher than what you're getting in a bank. Plus you're getting the dividends. Remember, I just explained this. Guaranteed growth of the policy, which is the guaranteed interest rate plus the dividend, okay? And it grows in a tax-free environment. So remember I gave you that last one was 34.2% cash on cash. Did you realize that's tax-free, okay? So now, to take this to the next level, to explain why somebody would want more than one life insurance policy, or more than a few, I guess you could say, if you were just playing the death benefit game, you start to see where the return on your capital really is advantageous, but not as advantageous as the ability to use the capital. So when you create your own banking system, the goal is to take back the banking functions in your life. The goal is to not use banks anymore. Like, don't take car loans from the bank. Take a car loan from your own private banking system. Don't take loans from the bank to pay off your credit cards. Take loans from your own private banking system because you're in control. And I could go on to houses and real estate investments and all sorts of stuff, because that's why it's called infinite banking concepts. But once you take and start using the capital for your life, to finance your life, you will start to see where you want as many of these as you can possibly get, because your capacity will start to explode. Your capacity to save money will increase. And let me unpack that, because maybe that's a bit hard to understand. Easiest way is on a piece of paper, write down all your debts and then write down the monthly payment and the interest rate that you're giving to those debts, okay? Do that. Add that total up, and then add the total interest rate and divide it by the number of debts you had on your paper. What you've just done is you now see how much money is leaving your family every month, okay? That's gone, that money's gone, it's paying your debt payments. But look at the interest rate, the average interest rate, okay? How much are you giving away? Is yours 6, 7, 10, 20%? Like, imagine a world where all those debts were your private banking system, and all the monthly payments that you just added up go back into your private banking system. And that average interest rate that you're looking at on that paper that right now today leaves your family is going into your private banking system. In other words, you're controlling all of that. You keep all of that money, okay? The only leakage in your private banking system is the loan interest that the insurance company charges you for taking loans from their general account. But you see, that's not even a big deal. That's what other people like Dave Ramsey and that would make you think is the worst part, but that's actually not a bad part. The insurance company is going to charge you interest. It's literally a profit center for the insurance company, okay? But your money, all of your money, so remember in that last one, my cash value was $60,536 or something like that, okay? All of that money is there in my account, earning a guaranteed interest rate, earning dividends in a tax-free environment, protected from judgments and liens in most states. Plus I get the death benefit, which is climbing. Sorry, Dave, I didn't mean to try to call you out, but you got that one wrong, buddy. Death benefit does go up in these specially designed whole lives. So I'm earning compounding interest on an uninterrupted basis while I'm taking back control of all the banking functions, the monies that I used to give away, and all the money I used to give away, of course, their bank charged interest, and now I'm paying that interest rate back to my banking system. Do you see, now I'm making money twice on every single dollar. I'm making the spread, which is what my policy earned, just use that one, 34.2% minus the cost of capital, which is the policy loan, and then I'm making money taking back the control of the monies that I used to give away, or making money on real estate portfolios or car loans or investments that I make. So once you start looking at that, you start to see why you wouldn't just want one. And to preface that, if you looked at any bank in any town throughout the United States of America, there's usually not just one branch. There's multiple branch offices of the same banks throughout different geographic, and demographic areas. So there are multiple branch offices, and your private banking system will be the same, just like mine. I have several policies, which those policies make up my private banking system. My private banking system enables me to finance the things that I want to buy in my life, the things that I want to invest in my life. I take loans from my private bank. I use that money to go out there and make more money, but I never stopped earning on the original capital in my private banking system, i.e. the cash value. It never stops earning, and it won't for the rest of my life. And it will every year make more than it did the year before. I demonstrated that on that one policy. And my death benefit will every year go higher than it was the year before, unless I have a term rider that falls off. That's the only caveat to the death benefit. So you can see how once you really start to understand this, and I'm probably not giving you enough info if you're brand new to fully unpack all of this, but we'll give you a video at the end that will help you really understand what I'm talking about. I'm just trying to wrap the idea of why would somebody have that many policies, because it does seem crazy, like it seems dumb. You don't need that many policies, but you do. When, and only when, you are building your own banking system, because I've never, ever heard of a traditional bank that doesn't want to grow their capital base, doesn't want to grow their deposits, doesn't want to grow their loans. That's how a bank makes money. That's how a bank expands. That's why a bank opens multiple branches. Your private banking system is no different. But you're not using their bank. You're creating your own banking system using specially designed and engineered whole life insurance policies. And as your life expands, as your income expands, as you take back control of all that money you were giving away and you become the bank instead of giving money to their bank, your capacity will increase, which means you will need more policies. Remember earlier I mentioned the MEC 7-pay rule, okay, the IRS rules. Here's the thing. Pre-1988, this is gonna be too much info, but pre-1988, you could put any amount you wanted into a whole life insurance policy, into any permanent life insurance policy, and there were no restrictions. But they kind of had to cap that because oil tycoons and the wealthy were dumping millions of dollars into these policies. There was no kind of restriction. So that was millions of dollars going into a tax-free environment that the government would never get any money from. And it's totally private. So the government wouldn't just lose tax revenue. They wouldn't even be able to see it because it's a private system, okay? So they said, all right, in 88, well, hold on, guys, we're gonna develop the MEC 7-pay rule. And what that says is for a period of 7 years, there's a calculation that looks at the premium deposits you put into the policy against the death benefit that you're buying. And if the death benefit is too low for the premiums, you are MEC'd. You are basically making your policy taxable like any other investment or taxable account. So by designing and engineering the policies, we are able to keep the death benefit the lowest or supplement a base death benefit with a term rider, because it's cheaper to get coverage, that then supports more and more money going into the policies. But no matter what, let's just hypothetically say I designed a policy for myself for $10,000 per year in premium deposits. Great. That's $10,000 a year that I can put in. And at that time, that's probably the number that worked for me, okay? But the year after, if I want to put $12,000 or $15,000 or $20,000 into that same policy, I cannot, because it was built according to those IRS MEC 7-pay rules. So that policy, in other words, that branch office of my private banking system has a capacity of $10,000 per year, not anything more. I can go lower, but I can't go higher. So now when I want to put $20,000 in, I got to start another policy. And you see, that just goes on and on and on. And I have 15 now, and that won't be all I have. I'll do another policy this year. But you see, eventually, and this will happen if you get real serious about this, you'll hit your human life value. And your human life value is a calculation the insurance companies do that basically says, this is the most life insurance you can have on your life, because this is what your human life value is. This is what your value to life is this, and you can't go any higher. Now that human life value pushes up as your income and your assets go up, but let's just call it that. If I hit my human life value, the insurance company says no more policies for you. So what have I done? Well, I have a daughter who now is going to be 6. She is 6 today. It's crazy to think. I have taken out 2 policies on her because I want to help her build her banking system. But she's got a lot more time than I do. And over time, her policies are going to be way better than anything I own. So I've started policies on her, my wife, okay? So we take policies out on my wife. And how about my mom? When my mom was insurable, I took policies out on my mom. So your family becomes your capacity. In other words, the policies don't all have to be on you, although if you're the breadwinner, they should be, up to your human life value, or a certain extent anyway. Then you should start building out to make sure that your family's private banking system is sufficient so that no matter what happens to anyone in your family, there is a death benefit to basically seed the next generation. The Rockefellers did this the best. Every family member born into the Rockefeller family, and you know what, maybe we'll give you, I've got a book, What Would the Rockefellers Do, that we did a deal with Garrett Gunderson. You should read that book. It talks all about the Rockefellers, but here's how they do it. If anybody's born into the Rockefeller family, their trust, okay, the Rockefeller Family Trust, we'll just call it that, buys a policy on that child and continues to buy policies on that child. Now the trust owns the policies because it has an insurable interest, but that child now has death benefit protection. If something should happen to that child or that adult when they get older, that death benefit goes back to the trust, seeding the next generation. But it's a huge increase, because that's a death benefit, right? You're gonna pay premium deposits to the insurance company. The insurance company is gonna promise a death benefit. When you die, the death benefit gets paid out to the beneficiary. If the beneficiary, in the Rockefeller's case, is the trust, that trust just got a bunch more money. And throughout that child, or all the Rockefeller children, throughout their lives, when they wanna buy something, they wanna finance something, they wanna start a business and they need capital, they don't go to XYZ traditional bank. They come to the Rockefeller family banking system. They put a loan proposal into them, I would imagine, and then that Rockefeller family banking system issues the loan to that child or to that adult, okay? That adult does whatever they're gonna do, buys a car, buys a house, all the things you can dream up of financing, starts a business, and then makes payments back to the family banking system. The same payments they would have paid to a traditional bank, except for now the whole family keeps all the money because they took back the banking functions, and it is self-completing. So that's like a high-level view of how the wealthy use this. But if you're just looking at this for the first time and you're like, well, I got to get started. I should have started 20 years ago, but you know what? Now is the best time. Great. You're gonna start with one policy. You're gonna design and engineer it so that it has capacity for the amount you want the ability to save. And you're gonna protect that capacity by making sure that there's enough flexibility so if something happens in your life, you can reduce the amount you're putting into the policy and then come back up to your max. And then when you max that out and all the money that you're bringing into your life, you can't put it into the policy to the amount you want, you're gonna start your next policy. And then that's gonna expand. But you see, it expands really fast. And this is the part I can't really help you understand until you actually do it. But just, again, go back to that piece of paper. If you were writing a check every month back to your private banking system for all the money that leaves your family today, how much wealthier would you be? How much more money would you have? How much better would your life be? I'll tell you what it is. Much better. And as you did that, then you started financing all the things in your life, all the things in your family with your own system, leaking nothing. You're not leaking any interest to somebody else, except for the interest you're giving the insurance company. We already hit that. Now all of a sudden, your life starts to rapidly expand. Now, as you start building your banking system, kind of like when you build an investment portfolio, diversification matters. So within all of my 15 policies, they are not the same insurance companies. They are all different insurance companies. So why would I use different insurance companies? Well, each insurance company has their strengths and they have their weaknesses. So when I build them, each new policy I set up, I choose the insurance company based on my needs and goals of that particular policy. If I need a policy that has the highest early cash value, I might go to one insurance company versus another. But if I'm building a policy for my daughter, who really what we want from that is long-term growth, I'm gonna go to a different insurance company that maybe isn't as strong in the early with the highest early cash value, but in the later years has a higher guarantee, has a higher dividend base, and just will grow better. So you kind of diversify your banking system based on your needs and goals at that time you're taking out the policy. And the other thing too would be, how do you pick and choose which policy to use for a particular loan? Because obviously different insurance policies have different loan interest rates, different dividends. Your one might be really old and one might be brand new, which is less efficient. So here's the thing. That is a very difficult question to answer without pure mathematics, without running the math. So for that one, I would always tell people we've created software called The Vault. The Vault mathematically organizes all these policies. You think I do this all from a spreadsheet? All these policies and the illustrations are in The Vault. And The Vault will then help me model and help show me the mathematics behind every single thing I want to do with the policy. And it will show me what the most optimum policy to use would be for a particular thing. If I wanted to take out a car loan for a new car I'm buying, I could go into the Vault, model the loan, run many different models, and then I can basically have the system tell me what policy is the most efficient one to take the loan for that particular car loan. And it can do that because it's all based on mathematics. So you can get the Vault by going to BYOBvault.com. We'll put that up in the description, but that helps you organize your private banking system when you start expanding. So I just wanted to use this example and just show you my little spreadsheet and some of my policies so you can get a better understanding of why somebody would have more than one policy. But I missed a lot of stuff. in here. And I wanna hit this video right here. You should watch this one. The Secrets of the Rich. This explains the infinite banking concept, and that is your first starting point. Thanks for joining me. Go out there and build your own private banking system, one branch at a time.